You've probably heard a lot of people making a ton of money on put options over the last month since the S&P 500 is down by 9%. But what you might not know is there's a ton of different ways to trade put options to where you can make money in any market. So in this video, I'm going to be giving you 4 put option strategies to help you make money no matter which way the stock market goes. We're going to be talking about the differences between each of these strategies and talking about the pros, the cons, and why you might use one strategy versus another. The first and the simplest way to trade put options is going to start by buying them and then selling them later on. But we need to talk about what it means to buy a put option. Whenever you buy a put option, you're signing an agreement to sell 100 shares of your stock at the strike price that you choose. And ideally, whenever we're trading, we want to buy low, sell high. So since we're signing an agreement to sell 100 shares of our stock at the strike price that we choose, we want the stock to be below our strike price. That way we can buy it at the lower market value and then sell it at our higher strike price. And this is where moneyness comes into play. If a strike price is above the current market value of a stock, then that put option is in the money because again, you can buy it at the lower market value and sell it at your higher strike price. But if the strike price is below the current market value of the stock, then that put option is out of the money, which means that it doesn't make sense to exercise the option to buy the shares at a higher price and then sell it at your lower strike price. You don't want to buy high, sell low. And if that option continues to be out of the money into the expiration date, then that put option is going to expire completely worthless. So if you throw $1,000 into put options betting on the market continuing to come down and your put option expires out of the money, then you lose that $1,000 investment.
And it's gone.
But on the flip side of this coin, this can make you a lot of money if you're able to time it correctly. Last week, I had one of my Discord members buy a put option on Adobe the day before their earnings report, and they were able to turn $50 into over $500 on that trade. And the reason for this is because implied volatility still remained extremely high because that day, Adobe fell by 20%, and people had no idea what to expect for the rest of the day. So since implied volatility stayed elevated and the stock dropped by 20%, they were able to turn $50 into over $500 for a 1,000% return. Again, this is extremely lucrative. You can lose whatever you put into the trade, or you can make 1,000% profits. Chances are you're probably going to be somewhere in between, because those 1,000% opportunities don't come around very often.
And the second number is 3. Oh! 3!
Yeah, I knew he wouldn't win.
And the reason for this is because most of the time, volatility is priced into your option. So if you're buying a put option ahead of a stock's earnings reports, or if you're buying SPY put options ahead of a Jerome Powell speech, they can still lose money if the stock doesn't move enough. And this is what's known as Ivy Crush, where everybody is piling into put options, creating a lot of demand for it, pushing up implied volatility, making these options more expensive, which means that you're potentially going to be overpaying to open the option. And if the stock doesn't drop enough, then you're not going to make any profit for the trade. This is why if you see an earnings report where a stock hardly makes any move, both call options and put options are going to lose value. So this is why I mostly avoid just buying put options and then hoping to sell them at a higher price, because there's too much involved with it. You have implied volatility to worry about. You also have theta to worry about because every day that passes, your option is going to lose theta value. And a way that you can mitigate this risk is by trading put spreads. Now you have 2 different ways to trade put spreads. You have a put debit spread, which works very similar to the way that a put option works, to where you're hoping the stock will be below your strike price on your expiration date. But instead of just buying one put option, you're buying a put and then you're selling a put with a lower strike price. The higher your strike price for a put option, the more expensive it's going to be, and we want to make sure that we pay a debit with a put debit spread. So you would buy a put option with a higher strike price and sell a put option with a lower strike price that you're hoping the stock will go below. So for example, right now SPY is trading for around $385, and if I think it's going to be below $380 in a couple weeks, I would buy a put option, say a $381 strike price, and then sell the put option at the $380 strike price, which I'm assuming SPY will be below. But the problem whenever you're doing these put debit spreads is you're limiting your max profit. Say if for some reason SPY bottoms out all the way down to $350, if I just bought a regular $380 put option, that put option would be valued $3,000. But with a put debit spread, I'm capping my max profit to the difference between my strike prices minus the debit that I'm paying in order to open the spread. So the way that I like to maximize my potential profits for a put debit spread is by going with an out of the money put debit spread. But again, if our put options expire out of the money, that means that they expire completely worthless. So if SPY is above my $381 strike price, I'm going to lose whatever I put into these spread options. So this is just like buying regular put options to where you're capping your max loss at whatever you're paying to open these put options. But on the flip side, you're capping your max profit to the difference between the strike prices minus the debit paid. So the way that you would choose between a put debit spread and a regular put option will be depending on how volatile you think a stock is going to be. If you think it's going to be more volatile, then it would make more sense to buy the put option in hopes that implied volatility is going to go up, making your put option more valuable. But if you think that implied volatility is going to stay relatively the same, then it would make more sense to go with a put debit spread. And these have been the two strategies to make profits whenever stocks are going down. But we talked about in the beginning of this video, you can make money no matter which direction, depending on how you're trading these put options. So let's talk about our bullish strategies for puts. And there's two ways that you can do this. You can start off by selling a put option, and whenever you sell a put option, you're signing an agreement that's opposite to the person that's buying the put option. So if you remember earlier, whenever we bought a put, we agreed to sell 100 shares of our stock at our strike price. Now, whenever we sell a put option, we're agreeing to buy 100 shares of our stock at the strike price that we choose. So the person that's buying this put option is going to pay us a credit in order to open this trade, since we're selling to open this put option, and we're signing an agreement to buy 100 shares of our stock at our strike price. And we're going to need enough cash in order to back that up. So if I have a stock that's trading around $100 and I want to sell a $100 put option, I'd be agreeing to buy 100 shares of the stock at $100, and I would need $10,000 in cash to put this trade on. So you need this cash in order to buy the 100 shares, which is the risk of the strategy. If the stock goes below your strike price, you have to buy 100 shares at your strike price if you let this option expire. And if it continues to come down past your strike price, then you're going to have unrealized losses since you bought the stock at $100 and now it's below that. And if the stock gets obliterated and falls all the way down to something like $70, that means you're down on $3,000 in unrealized losses, and it's going to take a while to recover that back. But on the flip side, if the stock is above your strike price on your expiration date, that means you're off the hook to buy the 100 shares at your strike price since that put option expired out of the money, which means that you get your cash back and you also get to collect the full amount of credit. So after you've done this and your option expires out of the money, you can resell that put option and collect another credit for the next expiration date. And you can rinse or repeat the cycle, continuing to make a recurring source of income. But again, this strategy is extremely expensive because we have to buy 100 shares of our stock at the strike price that we choose. And if we want to trade something like SPY, that would cost us over $35,000, and not everybody has that kind of money to trade with options. So a way that you can bring down the amount of money that you need is by using the put credit spread strategy. And the way that this strategy works is just like we explained with the selling the put option, to where we're agreeing to buy 100 shares at the strike price that we choose, but then we're going to buy a put option with a lower strike price. And remember, put options are more expensive the higher your strike price, so we're selling the higher strike price to collect a credit and then buying the put option with a lower strike price to bring down the amount of money that we need. And the amount of money that you need whenever you open a put credit spread is going to depend on the difference between your strike prices. If you have a $1 difference between your strike prices, you're going to need $100 in collateral. If you have a $5 difference in your strike prices, you're going to need $500 in collateral. So you're going to multiply the difference between your strike prices by 100 since you're controlling 100 shares of the stock, and you're agreeing to buy 100 shares of the stock at a higher strike price and sell 100 shares of the stock at the lower strike price. This means that if the options expire in the money, you're going to have to buy at the higher strike price, sell at the lower strike price, so you're buying high, selling low, which means that you're going to take a loss. And the amount that you lose whenever you open a put credit spread is going to depend on how much credit you get. You're going to take the difference between your strike prices, subtract the credit that you get, and that's going to be your maximum loss for opening a put credit spread. So if I get, say, $30 in credit for a $1 spread, that means my max loss for opening this put credit spread is going to be $70. And that's if the stock is below my strike prices on my expiration date. Again, we want these options to expire out of the money, but if they expire in the money, that's our max loss scenario. But on the flip side, if the options do expire out of the money, that means we get to collect the full amount of credit that we got to open this trade. So if I sold that $30 put credit spread and these put options expired out of the money, that means I get to collect that full $30 in credit. And with any of these strategies, you can close them long before the expiration. You don't have to hold it into your expiration date. If you're doing a put credit spread, then the way that you're going to close this is by either using the close function if your broker has it, or just doing the opposite to how you opened it. So you'd be buying the higher strike price back since you sold to open that option, and then you'd be selling the put option with the lower strike price since we bought to open that option. Now, if we go back to the put debit spread, it's going to be the opposite. Since we bought the higher strike price and sold the lower strike price, we're going to close it by selling the higher strike price and buying the lower strike price. And whenever you're selling a put option in order to open it, the way that you're going to close this is by putting a buy to close order. So since you sold to open this option and you're buying it back, you want to buy it back at a lower price. That way you make a profit. And finally, if you're buying a put option to begin with, you want to sell it at a higher price, and the way to close this is just going to be a sell to close order. And really the idea with any of these strategies is going to be to buy low, sell high. Doesn't matter if you're selling first or if you're buying first, you want to buy the options at a cheaper price than what you sold them at. So if you're selling them to open, you want to buy them back at a lower price. And if you're buying these options to open, then you're going to want to sell them at a higher price to make a profit. So hopefully you can make some profits by using these strategies. Thanks for making it all the way to the end, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.